This week in economics on the 19th of July 2015. Numbers man here, and a pleasant weekend to everyone. The head of the Federal Reserve in the U.S., Dr. Janet Yellen, testified before Congress in annual testimony. You'll hear that as we leave our part of this. And we edited this. It was about a 3-hour testimony where various questions were answered. We'll start with our open statement depending on which platform you're on, and then you'll hear some of the other opening statements from members of the panel, such as Maxine Waters from Los Angeles. On the economy, they are members of Congress are allowed to make pre-statements, and then some of the answers Q&A from various members of Congress will enlighten one to what the Fed's policy is. You'll hear there's a big argument or controversy, whatever, on the so-called transparency of the Fed. What we'll say at this point in time is that the Fed is more transparent today than it has ever been. The news conferences, the reports after FOC Fed Open Market Committee meetings, and that is a guidance. Now, the big argument here is the Fed telling the public what it will do in terms of, say, interest rates. Well, that in itself is a situation that the Fed has to be independent. Therefore, certain things could cause jitters in an already quote-unquote jittery market. Now, as far as letting the people know what the Fed is doing a pretty good job of doing exactly that, detailing where the balance sheet is and what the stratagem is. But as far as specific to the market, and this is one of the things you have to look at. The market itself is the market. That is a purely speculative body. Such things as interest rates affect everything from mortgages to savings accounts, etc. And those are raised or lowered based upon how the Fed sees the economy reacting. And the economy is very, very mixed. There are some that say that the Fed should not raise rates until next year. And the Fed is talking about a very incremental rate raising policy. If you go, say, for instance, into Q3, or into actually where we are now is Q3, you go into Q4, it doesn't make that much difference. The argument of this specific individual was waiting until, say, the spring to do it. There are others that, like Paul Klingman, for example, would talk about more stimulus. Now, that would be from the Congress, not from the Fed. And the other big topic is the banking regulations part that the Fed has under the Frank legislation that is now there for banks, and such as stress testing, etc., and where this plays to community banks and how they comply with the regulations. And Dr. Yellen made it very clear that the Fed's their part of it. You, of course, also have the control of the currency, the bank examiners there, but they would alleviate as much as they can for the community banks as opposed to the large commercial banks. And the reason for this is not to repeat the circumstances that causes depression. That is the whole idea there for regulations. Now, the right-wing types that advocate generally for laissez-faire would oppose this and would like to curb these regulations or modify these regulations. It's not going to happen under this particular Fed and the voters in the Open Market Committee. It will remain as is for some period of time that we can expect, because the markets need normalcy. And also, this is is a global market, and the other banks across the globe are operating in a very similar manner. So therefore, the Fed will operate here. And this is something that is lost. The U.S. is not an exclusive market in itself. Now, there are some activities within the U.S., yes, but when you get to, say, mortgage-backed securities, etc., those markets, and you get into banking in general, and even into the stock market, all that is internationalized. The hedge funds are international, global. The banks are global. We look at what has happened to Greece. The only thing we can say there is the banks will open next week, and Greece was forced to sign their bailout. And it was a very predatory bailout. Now, will this bailout work? The Greek finance minister, former Greek finance minister, said it will not work. So we'll be looking to see exactly how that unfolds in a number of days. What we will venture here is a lot of what the Germans pushed for was so-called austerity. Austerity has proven not to work. Let's take care of one other little side issue. Google increased income rose 17% to $3.9 billion in 3 months from June to June. So that the quarterly last year boost 11% there. So that is from the Google operation jumped shares jumped 5.7%. It is in the 600s now. Has already raised. The share price 3.5%. Looking at the page here, and Google has risen through their YouTube venture and also pay-per-click, or the average price of online ads. Google's ad revenue has been under pressure as consumers across its services on mobile devices, not as smartphones, tablets, where the advertising rates tend to be lower. Now, that has been a situation that they have had to deal with for quite some time. Let's go now to, this is July, this is the third estimate of Q1 of 2015. This is from the Bureau of Statistics. Real gross domestic product, as GDP, decreased 0.2% on the annual rate in Q1 of 2005. That's according to the National Income and Product Accounts. The third estimate of real GDP growth in the first quarter was revised up 0.5% from the second estimate. Exports decreased less than previously estimated. And this is one of the things that we see appearing here through the various estimates. First quarter decrease in real GDP primarily reflected negative contributions from exports, non-residential fixed income, state and local government spending were partially offset by positive contributions from consumers, inventory investment, residential fixed investment, imports, which are subtracted in the calculation of GDP. Price of goods and services purchased by U.S. residents decreased 1.6% in Q1 after decreasing 0.1% in Q4. Energy prices decreased more in the first quarter than in the fourth quarter. Food prices turned down, excluding food and energy. The increase was 0.1%. Real disposable personal income, that's DPI, increased 5.3% in Q1 after increasing 4.1% in Q4. Current dollar real disposable income increased 3.2 in Q1 after increasing 3.7 in Q4. Corporate profits from current production decreased 110.8 billion in Q1 after decreasing 30 billion in Q4. Real domestic income increased 1.9% in Q1 after increasing 3.7% in Q4. Now, this is an overview here. Real GNP turned down in the first quarter as the dollar strengthened against other currencies, as imports and exports were delayed by the West Coast port labor dispute, as energy prices fell and the service, as a severe winter affected much of the nation. The downturn primarily reflected a slowdown in consumer spending and a downturn in exports and non-residential fixed investment. In states and local government spending were partially offset by an upturn in private inventory investment in federal government spending and deceleration in imports. The slowdown in consumer spending reflected slowdown in spending for both goods and services. The slowdown in spending for goods primarily reflected downturn in clothing and footwear, in motor vehicles, parts, and a slowdown in other non-durable goods, primarily pharmaceutical products. The slowdown in spending for services primarily reflected a downturn in other services, primarily mobile phone services. A slowdown in healthcare and food service and accommodations were partially offset by a pickup in electricity and gas. The downturn in non-residential fixed investment was mostly accounted for by a downturn in investment in structures that were primarily due to a 48.6% decrease in mining exploration. Shafts and wells are the largest decreased since Q2 of 2009. An upturn in investment inventory investment primarily reflected an upturn in inventory investment in manufacturing industries, in retail trade industries, and in other industries, notably information industry. The downturn in exports of goods mainly reflected a downturn in exports of food, feed, and beverages, large decrease in exports of non-automotive capital goods, downturn in exports of other goods. The slowdown in imports mainly reflected a slowdown in goods imports, particularly petroleum and products. Upturn in federal government spending primarily reflected a small decrease in defense spending. The downturn in state and local spending was primarily accounted for by a downturn in investment in structures. Final sales of domestic product, real GNP, less inventory investment decreased 0.6% after increasing 3.2%. The third estimate for the first quarter changes in real GNP was 0.5 points higher than the second release in May. The upper revision primarily reflected upper revision to exports and consumer spending, to inventory investments, to non-residential fixed, to state and local government spending that were partially offset by upward revision to imports. The upward revision to consumer spending was accounted for by an upward revision to both goods and services. Upward revision to goods was primarily accounted for by food and beverage purchases for off-premises consumption. In other words, the old six-pack take-along stratagem. The upward revision to goods, we had that one, sorry about that. The large contribution to upward revision to services were transportation services, primarily ground transportation, final consumption expenditures of non-profit institutions serving households, primarily hospitals and nursing homes. Upward revision to non-residential fixed investment reflected upward revision to structures and to intellectual properties products. Upward revision